see. Okay, so you want to just go through the quiz, or you want to work particular ones, or we did number 1. Were all of you guys in that early class? Yeah, we didn't do the number 3 in there, so we'll do that too. Or maybe we can change the numbers and do it. We went through just the first one. Yeah. So maybe we'll start with number 2. Back to allowance for doubtful accounts. This question looks like it's different than you've seen before, but it's really not. If you just let yourself figure out where you're at, figure out what you want to do, and make your adjustments your own. And then analyze what the impact of that is. It's just gonna fall out, okay? So lots and lots of questions T accounts work. You don't have to use T accounts, of course, but it kind of keeps you straight, right? It keeps debits straight and the credits. And so, maybe we'll set up some T accounts for this, work to figure out what the journal entries are, and record it, huh? So on number 2 there, compute the ending balances and allowance for doubtful accounts and bad debt expense. So what I would think I wanted to know is what is the ending balance in the allowance account, which is of course going to be a credit because it's a contra asset, right guys? And what is the ending balance going to be in bad debt expense? That's what I'm looking for, which of course is going to be a debit balance because it's an expense account, right? So I already know what I'm looking for. So, reading one sentence. And they're independent situations, so you're working each of them independently. If you start mixing them together, it'll go crazy. The ending balance in accounts receivable is 120. What account goes on the balance sheet with accounts receivable? Allowance, right? The allowance is the portion of the accounts receivable you expect to never collect. Is that right? That's what it is. Now you've read the chapter and you studied a little bit. That's what it is, isn't it? Okay. So the ending balance in accounts receivable is 120,000. Is that a debit or a credit, guys? Debit or credit? What do you think it is? It's accounts receivable. Debit or credit? It's a debit because it is a asset. You have to know that, and people will mess that up too. A little mental glitch or something. So yeah, it's an asset. Why does the allowance have a credit balance? Because it's a contra asset, right? Okay, good. And then it says sales are 600,000. Well, what's bad debt expense? It's the portion of the sales you're never going to collect, right? It's your estimate of the sales you're never going to collect. It's an expense on the income statement. And of course, sales is revenue on the income statement. Sales has what kind of a balance? Debit or credit? Credit, because it is a revenue, right? Everybody in the room answered those to yourself, right? You did, okay? Make sure you do. If you have any questions, if that answer didn't register with you, get your hand in the air, right? It ought to be by now. Yeah, that's what they are, okay? So, all right, anyway, so what did we start with in bad debt expense and sales for the year, by the way? In bad debt expense and sales, don't read the problem, just think about what it started with when you started the year. 0, why? Close them. Yeah, you close them, right? So they started at nothing, of course. We don't particularly need that for this problem, but that's what they started at. And the way the credit got into sales is they credited sales a whole bunch of times for a total of 600. Okay, and we're going to put the debit into bad debt expense that it needs to be. That's what we're going to do here. So what we want to know is what's the ending balance in bad debt expense and what's the ending balance in the allowance. And okay, good. Okay, then it says there's a credit balance in Part A. Credit balance of 2,000 allowance for doubtful accounts. How did that get there? How did that get to have a 2,000 credit? I bet they made some credits to the account in the past and maybe some debits to the account in the past. When they started using that account, it started with nothing in it. When would you credit it? When do you credit allowance for doubtful accounts? When do I do that? When do I credit allowance for doubtful accounts? This account here. When do I credit it to get that balance in the first place?
When you know they're not going to pay you.
Really? When you find out they're not going to pay you? I think when you estimate how much is not going to be paid to you. It could be you look at different customers, the whole list of customers, and you say, okay, this person's going to pay me, this person's not going to pay me, this person's going to pay me, this one's not. And I come up with my estimate of what I'm not going to get paid. I don't know they're not going to pay me yet. It's my estimate of what I think I'm not going to collect. So I would credit the allowance. That's how that credit got in there in the first place, okay? I'm going to credit the allowance and debit what? That credit to allowance is all, the debit side is going to be what, guys? Crediting allowance for doubtful accounts, increasing it. What am I going to debit? What am I debiting? I'm estimating how much I'm not going to be paid here. That's going to be bad debt expense, okay? So this journal entry, debiting bad debt expense and crediting the allowance, right? What I'm saying is, okay, what portion of the sales am I never going to see? That's going to be my debit to bad debt expense, okay? And then, what portion of the receivables am I never going to see? That's going to be the credit to the allowance. That's the idea. You debit bad debt expense and credit the allowance because you estimate that a certain percent of your customers aren't going to pay you, or a certain percent of your sales is never going to be collected, right? But what they represent, bad debt expense is going to represent the portion of the sales never collected. Allowance for doubtful accounts is going to represent the portion of the receivables never collected, okay? So in the first one, there's $2,000 left in the allowance. I increased it with credits. What did I do to reduce the allowance, by the way, over time? I would reduce the allowance. That's when I find out that somebody's not going to pay me. When I realize a particular customer is not going to pay me, what I say is, okay, I no longer need that amount in accounts receivable. So how would you reduce accounts receivable for the ones you think aren't going to pay you? You'd credit accounts receivable. And what would you debit? I found some of the allowance I don't need, right? It takes a few times through this to sort of get your head around it. Allowance for doubtful accounts. So I create the allowance when I estimate how much is not going to be paid to me, and then when I find one that's not going to pay me, I debit the allowance because I found it, okay? When I give up on a receivable, I take them out of receivables, don't I? That makes sense, wouldn't it? Everybody good? Okay. So in this problem, we don't need all of that for this problem, we do for other ones, but there's a credit balance of $2,000 in the allowance, and uncollectibles are 2% of credit sales. Okay. What would we be estimating if we use 2% of those credit sales? What's that going to be? $3,000? No. 12,000. 12,000. Okay. Maybe half of it, right? 2% is going to be $12,000, right? What's going to be $12,000? Yeah. I want this account to be $12,000. I already know one of the answers. No kidding. Bad debt expense is $12,000. Now, how's that going to happen? Well, it's zero now, you guys. What are you going to debit it for to make it 12,000? I think 12,000, don't you? And what are you going to credit? That'll be debit bad debt expense, $12,000. What are you going to credit? Allowance for doubtful accounts. So I might ask you to do the journal entries, which would be the answer, right? Fine. Or I might ask you for what the balances are going to be. Well, then there's 12. But what do we have in the allowance now? Take a look at this. In the allowance, we had, before we started making adjustments, we had, what was it? 2,000 credit? And what am I going to have to add to that, seeing as I credited it for 12? 12. And what do I now have in the allowance, everybody? $14,000. There's the other answer. That easy. Okay? And then again, if it asked for the journal entry, it'd be this, wouldn't it? Okay? So that's part A. Pretty straightforward, maybe, I hope. What happens in B? It says it's a debit balance of $3,000 in the allowance. How did that happen? How would you get a debit balance of $3,000 in the allowance account? Allowance for doubtful accounts has a debit balance of $3,000 in it. How would that happen? It could happen. what might you have done? Let's say last year, you wrote off, not under, it'd be over. You undershot your estimate. Is that what you meant? Your estimate wasn't big enough. You wrote off more than your estimate, right? So maybe what we had last year was 10,000 in here, because we debited bad debt expense credit allowance and brought it up to 10,000. How many would you have written off to get down to a 3,000 debit here with the write-off entry? It had to be 13, right? It'd be debit allowance for doubtful accounts and credit what? We wrote it off. What do we credit when we write them off, guys? Accounts receivable. Debit allowance, credit accounts receivable. You don't have bad debt expense when you write it off. You have bad debt expense when you estimate it. Okay? It's the allowance method. The direct write-off method they talk about in the chapter, which is not generally accepted accounting principles, but if it's real small amounts, it's immaterial and nobody cares. You could use that if they're real small amounts, right? Because they're immaterial. Right? What does that method do? Debit bad debt expense and credit accounts receivable directly. Seems easier, doesn't it? But what happens is you get bad debt expense in a different year than you had the sale. So you'd overstate the income in the year you had the sale, and then understate the income the next year when you wrote off the account. Does that make sense? Okay? So what we do is we debit bad debt expense and credit allowance, and then when we write them off, we do this. Debit allowance and credit accounts receivable. Okay? That gives your head around that kind. Okay, guys. So, guys and gals. Here we go. This time I've got a 3,000 debit balance in here because I wrote off more than my original balance, okay? And we also know the accounts receivable is still how much? Everyone's got the same stuff, right? Otherwise, this is 120,000, okay? And then bad debt expense, what would you have in there? Nothing, right? Start at nothing. And sales was still 6 million, wasn't it? Or 600,000, I'm sorry. Okay, so in part B, what does it say? Uncollectibles are 2.5% of credit sales. So what would you do? I'd take 600,000 times 2.5%, wouldn't you? How much is that? 15? Okay, and what am I going to do? I want bad debt expense to be 15,000, don't I? If I am making my estimate of what's going to be uncollectible on sales, sales goes in the income statement. What is the estimate of the sales you're never going to collect? What do we call that? Bad debt expense. Okay? That's it. Got it? So I'm going to put 15,000 into bad debt expense. Debit, bad debt expense. So if I ask for the journal entry, this would be it, right? And credit what? To replenish the account. What is it? Yeah, allowance for doubtful accounts. Got it. It's always debit, bad debt expense, and credit allowance to replenish the account. It's just different dollar amounts, right? Under different assumptions. So yeah, so I'm going to put 15,000 in here, but I didn't want the journal entry this time. If I did, that'd be the answer. I wanted to know the ending balance. What's the ending balance in bad debt expense, of course? If I put 15 in there, that's debit. There's the journal entry. It's 15,000, of course, so there's the answer for that. And then what's the balance in the allowance? Be careful. You started with 3, right, debit, and you credit it for 15. What do we have now? 12,000. That's it. The answer would be 12. Okay? 12 and 15. 12 in the allowance, 15 in the bad debt expense. That good? Not even a big problem, is it? Okay, let's try C. Okay, in C, the allowance for doubtful accounts, accounts receivable. I think accounts receivable still stayed 120,000, didn't it? Bad debt expense is still nothing because we haven't put anything in there before the adjustment. Sales is 600,000, okay? Now, C says credit balance of 2,000 the allowance. 2,000. And then it says, prior to any adjustment. Uncollectibles are 10% of receivables. What's 10% of accounts receivable? How much is that? 12,000. What account should be 12,000? Which account is my estimate of the receivables I'm never going to collect? Your allowance. Yeah. I want this one to be 12,000. Does that make sense? So now, too, I want it to be 12. What is bad debt expense? It's my estimate of the sales I expect never to collect. Man, if you can get that, you got this made. If you don't, it'll drive you crazy. Again, what is my estimate of the accounts receivable I'm never going to collect? On my balance sheet, I'm going to show accounts receivable less what? In this case, I'm going to show 120,000 accounts receivable, and what am I going to subtract from that for the portion I expect never to collect? 12. And what do we call that? What account is it? Allowance for doubtful accounts. That's the contra asset that goes with accounts receivable. What's my net realizable account receivable? What do I expect to collect? 108,000. Got it? Okay, that's all we're doing. Okay? Which account represents the sales I'm never going to collect? I'm going to put the sales in the income statement. Which account on the income statement represents my estimate of the sales I'm never going to get? So that's one of the costs of getting the sales, is incurring bad debts, huh? Which one is it? Bad debt expense. Keep those straight. That's the most common mistake. People just get all screwed up, going different directions for this. Okay? All right. So if I want this to be 12 in the allowance, and it is now 2, can anybody tell me what to do? How about crediting it for 10? That's all there is to it. So the journal entry is going to be credit the allowance for doubtful accounts. Always the same accounts, right, guys? Just different dollar amounts. And what am I going to be forced to debit for 10,000? Bad debt expense. And so now I've got bad debt expense with 10 in it. That's the answer, right? And I've got an allowance with 12. That's the rest of the answer. If I ask for the journal entry, it'd be that. Okay? Hard. It's not hard, is it? They aren't hard. It's fun. Okay, D. Debit balance and allowance. Again, how did I get a debit balance and allowance for doubtful accounts? I must have written off more than my original balance at the beginning of the year. Because when I write them off, what do, you guys? Again, what do? Here's how I replenish. Debit, bad debt expense, credit allowance. When I find out about an account, right, that I expect never to collect, what do I want to do? Take it out of what? Accounts receivable, right? And also take it out of the allowance. Let's say that we had this situation here with 12,000 in the allowance account here, right? And my net realizable receivable is 108 because I have 120 of accounts receivable. Let's say I wrote off a $1,000 account. What would the entry be to write off a $1,000 account? What would I debit? Allowance. What would I credit? I'm not changing bad debt expense because I found one. I already set up the bad debt expense with a debit, bad debt expense, credit allowance. It's going to be accounts receivable. Debit the allowance, reducing it because I found one, right? And reduce the receivable because I'm giving up. So what would my accounts receivable be? Say I did it right away. I'd have this 120 go down by 1,000, wouldn't I? And it would be how much? 119,000. Everybody see that? And then what would that debit do to the allowance if you had 12 in there and you debit it for 1? What would you now have? 11. Look at this. What's the ending balance, or the net realizable receivable? What is it? 108. Wait a minute, it's the same number. Sure it is. All you did was you made your receivables one smaller and you made your allowance one smaller. The net realizable receivable is the same. You just found one of them. No change to bad debt expense at all. No change to net income. When do you record bad debt expense? In the period you have the sale. When do you record writing off an account? In the period you give up. Probably not the same year.
So,
right?
so for D, there's no change.
No, that wasn't D. That's just what would happen if I wrote one off. All I was saying is, how do we get a $3,000 debit here? How did you get a $3,000 debit? Maybe you started with 10 in the, well, maybe we started with 12 in the account. How would I make this a 3,000 debit now? I have a 12 credit in it. How much must I have written off to get a 3,000 debit if that were the case? 15. If you have a 3,000 or 12,000 credit in the account and you write off 15, you'll debit the account for 15, won't you? And you'll have a debit balance of 3. That was the point I was trying to make. Okay? So now let's work D. How does it work? What happens with D? We have, yeah, so if this is 120, and you'd like it to be 10% of that, see, it's going to be one or the other. You're either going to make it a percent of the sales, which will make it, that be bad debt expense, or you're going to make it a percent of the receivables, which is going to make it be the allowance. Huh? So what do I got? $12,000? What do I want to be 12,000? The allowance. Is that going to be a debit or a credit? Credit, of course. So how much are you going to have to add to this thing? Looks like 15 to me. So right now, bad debt expense is how much? Nothing. We haven't done anything to it yet. And sales, what do we have? 600,000. But I'm not basing my estimate on sales. I'm basing it right here on receivables. Okay, that's a portion of the receivables I expect never to collect. So journal entry, you guys, what is it? Debit what? What would I like bad debt expense to be now, I guess? 15, because I have to put 15 in here. So if I put 15 in here, debits have to equal credits. It's going to be 15 over here. And I'm going to have 15 for an ending balance. You don't have to write down these entries to get the answers, do you? You can just do it in T accounts. But it's going to be debit bad debt expense. Entries might keep you straight, though. 15 grand. And credit the allowance for doubtful accounts. 15 grand. Okay? You guys see it? Where am I at? Where do I want to be? That's all adjusting entries are. Just another adjusting entry. Okay? We'll do another one of these before we're done today. Okay?
In all these cases, they should always be the same number then? Right, because like, you have the ones for doubtful accounts, they always equal each other, pretty much?
No.
Or is it just the journal entry?
I've got,
You need to put the ending balances, I'm guessing?
it asks for ending balance and allowance for doubtful accounts, right? So my answers would have been 14 for allowance for A and 12 for bad debt expense. And then for B, ending balance would be 12 for the allowance. Bad debt expense would be 15. For C, ending balance of the allowance is 12. Bad debt expense is 10. And for D, ending balance for allowance is 12. That's because I used 10% both times, so then it's the same, right? But it's going to be 15 for bad debt expense. So they'll be different, yeah. If they're the same, it's just because I used the same estimate, right? If I'd have used 2% of sales in both of them, bad debt expense would have been 12 both times too, right? Yeah. So sometimes I'll ask for balances, sometimes I'll ask for what's net realizable receivables, right? Receivables less the allowance. Sometimes I'll ask for the journal entry, okay? So if you know what you're doing, you can do any of that. You have to do all of it anyway to get the answer.
Since you get back the expense from the sales and the bad debt allowance from the receivables, how can you get the expense from the 10%?
You can't get both of them. You only get to have one estimate where you want it to be. So what we've got here is in A they say they are, in A they're making their estimate based on sales. So they're estimating bad debt expense. So you force bad debt expense to be 12,000, okay? And then allowance for doubtful accounts just falls where it does. You only get to do one, you don't get to do both. It's impossible to do both. Does that help? And then when you look at B, this time we're estimating based on sales again, right? Happen to be, I put them in order. I can put them in any order, of course. This one's 2.5% though, so now bad debt expense is 15, and the allowance just falls wherever it happens to, okay? Then in the other two, when you get to see what's happening, this time I'm estimating based on receivables, so I'm estimating the allowance. So I bring the allowance from where it is to where I want it to be, right? So I put 10 into it. And that forces bad debt expense to be 10. I didn't really estimate bad debt expense based on receivables, did I? I estimated the allowance. And on the earlier two, I didn't really estimate the allowance, or estimate bad debt expense. I estimated the allowance, yeah. Right? Okay. That helped. Okay. And the same thing with this one. I said it was 10%, right, of receivables, so guess what happens? I force the credit to be 15,000 to get there, right? Which forces bad debt expense to be 15. I think a lot of people do try to do both sides at the same time, and your brain explodes, huh? Just get one or the other. Okay? Lots of estimates are going to be this way. Good. Better? Worse? We'll do another problem like this. Maybe from the homework. Want to do number 3? Okay, on this one, it talks about ending inventories being messed up and what would be the impact on assets, liabilities, equity, revenue, expense. Okay. Thing to keep in mind is the ending inventory of one period, a millisecond later, is the beginning inventory of the next period. When you calculate cost of goods sold, what happens, you guys? When you do cost of goods sold, what happens in cost of goods sold? How do you calculate it? Beginning inventory plus purchases is what's available, right? Then you subtract the ending inventory, right? And what does that give you? Cost of goods sold. It's true, isn't it? Okay, so the problem we get into is if there is an error in ending inventory here, that causes an error the next year in the beginning inventory. So we're going to do 2012, and there'll be a mistake in ending inventory. Guess what that does to you? It gives you a mistake in the beginning inventory of 2013. And that's the trick, guys. Okay? That's it. Every time that happens. What do you do with the beginning inventory? Does beginning inventory make cost of goods sold more or less? Seeing as you add it to the purchases. It makes it more, right? It's beginning inventory plus purchases is what's available, right? Then what do? You subtract the ending inventory, don't you? So what happens? The ending inventory reduces cost of goods sold. The beginning inventory increases cost of goods sold. We always assume we sold the beginning and kept the ending, right? Kind of the truth, isn't it? Okay. All right. So let's try this little problem. Oh, by the way, cost of goods sold goes where? On which financial statement? Expenses on the income statement. Where does inventory go? Assets on the balance sheet. You guys know that, of course. It's building little bit by little bit. Just I'm trying to have you learn more than you possibly can in the period of time that we've got. That's good. Because some of you will learn it. And all of you will learn a lot more than if I didn't expect very much. It's been my experience over the years, right? So, no kidding. If I expect very little, guess what students do for me? Very little. I do exactly the same thing. Right? Do what you have to do. Get the job done. That's it. Just need to develop judgment as a professional. How much you need to do. Make sure you do enough. By the way, it's unethical to do more than you need to do. You're billing somebody $200 an hour for your time. Should you do stuff that's not necessary for them? No. Theft. She's stealing. Besides, they'll fire you and hire a better professional because you're too expensive. You only do what's necessary. You always walk on this tightrope. You only do what's necessary, but you don't ever do any less than that. So if you do less than that, what's the deal? Well, you did a poor job, right? But if you do more work than you needed to, you stole the fee. We didn't need to pay you for something they didn't need to have done, right? So always. But trust me, you have so much work to do anyway, you won't want to do more than you need to. All right. So what do we know in this case? It says what? Well, the ending inventory, okay, is understated by 3,000. This is too low by 3. And I guess from that we could assume that beginning is okay, purchases is okay, and that makes available okay. Got it? You're subtracting 3,000 too much, so what's wrong with cost of goods sold? No, you're subtracting 3,000 too little. It's understated. So yeah, you're right. We're subtracting 3,000 too little, which makes cost of goods sold 3,000 too much. Everybody agree? That's it, isn't it? So cost of goods sold is an expense. It's going to be too high by $3,000, right? It'd be overstated. You got it. And net income then would be? If revenues are okay and expenses are too high by 3,000 because cost of goods sold is too high by 3,000, what's wrong with net income? It's too low by 3. Which does what to equity? Specifically retained earnings in equity. If you think about retained earnings, it's going to be what? 3 too much debit, right? Not enough credit, however you want to look at it. Okay, 3 too low, isn't it? Okay? And then what about liabilities? Nothing's wrong. Okay, well, what would that mean for assets then? If equity's too low by 3,000, it's going to be understated by 3 also. And does that make sense? Well, yeah. Our ending inventory is understated by 3. That's it, isn't it? Okay, then things get tougher, though. This 3 ending inventory too low makes beginning inventory be what? Oh, still understated. Beginning inventory. Ending understated, beginning must be understated. It's going to have the opposite effect on cost of goods sold, though, right? Because I add the beginning inventory and I subtract the ending inventory, okay? So the error is going to correct itself. But if I'm understated at the end of the year of 2012, I'm still understated at the beginning of 2013. A millisecond later, you guys, right? New year starts. Everybody good? It's not even a millisecond. It's not that at all. Everybody got it? So I'm gonna add 3,000 too little at the beginning, and I'm going to add it to the purchases. What does that do to available, you guys? Too low by 3, doesn't it? Now let's assume my ending inventory was okay. It's not in this problem, but assume it was okay. What would that do to my cost of goods sold? Understated by 3. So look at that. The errors offset, corrected itself across the 2 years. So your total income for the 2 years in total is going to be okay, right? Of course, you still want the years to be correct. People are looking at what's happening to your income year to year. So, okay? So if cost of goods sold is too low by 3 now, and net income's okay, revenue's okay, I'm sorry, what's wrong with net income? Overstated by the 3. And what'll that do the second year to retained earnings? So here's 2012. What would that do for 2013? That would overstate it by 3, and look at that. If you didn't have an ending problem, an error in the ending inventory in the second year, that would be 0 effect on equity, huh? And then, yeah, we do. But also, what would be the case for assets at that point? It'd be 0 error here too, right? That would be fixed, wouldn't it? So we'd have no problem with anything. But in this problem, what happens? The ending inventory is not okay, is it? So what happens? Overstated or understated? What was it? Overstated by 5. Now, an overstatement of the ending inventory will do what? You're subtracting too big a number. What will that do to cost of goods sold? It'll decrease it by 5. Right? So those two added together is how much too little cost of goods sold? 8. Everybody got it? True, isn't it? One error reducing cost of goods sold by 3, and another one reducing cost of goods sold by 5. So my cost of goods sold is too low by 8. So I've got total here of 8 understatement, right? 5 plus 3. for cost of goods sold. Everybody see it? Which makes my net income how much too much? 8. Okay? So what'll that do over here? What does that do in 2013?
Their expenses are overstated.
Not understated. Net income overstated, which makes what? Equity overstated, retained earnings by how much? 8. But what's the net effect of understating it 1 year by 3 and then overstating it the next year by 8? Net overstatement of 5, which is going to be very handy because that's how much my ending inventory is off by, right? How much is my ending inventory overstated at the end of 2012? Or 2013, I'm sorry, the second year. Overstated by how much? Inventory. 5. So I have an overstatement here by 5 and an overstatement on equity by 5, and I'm in balance. And my net income is overstated by 8 to make that happen. Oh, man. Let's add one more year. Let you guys do this. Do 2014, and all I'm going to tell you is there's no error in ending inventory. It's a continuation of where we were at the end of 2013, and there is no error in ending inventory. Can you do it? Give that a shot. That's not in the problem, by the way. It's just adding to it. But I can keep going year after year after year. It wouldn't matter. There's no error in ending inventory. Is there an error in the beginning inventory? Yeah. So be sure and pick that one up. And then there's no error in ending, and you got it made. See what happens. See if you can run it through. You can see if you did a number of years, this might drive you crazy. But if you're going back and you're correcting financial statements for companies that were messed up, you have a different situation. Increase their income. Just think about what's wrong with the assets. And that must be what's wrong with the equity at the end. For the beginning, how much are we off by? Not 8, just 5, just the ending inventory. The 8 was what was wrong with the net income because it was 2 years of mistakes put together, right? So what's wrong with your beginning inventory? Too high by 5. Okay, good. Assuming my purchases are fine, what's wrong with my available? Too high by 5. Assuming my ending inventory was okay, because that's what I gave you, right? No problem at the end. What's wrong with my cost of goods sold? Too high by 5, right? If your bill is too high and your ending inventory is okay, right? Cost of goods sold is too high by 5. If cost of goods sold is too high by 5, and there's no effect on revenue, what's wrong with net income? Too low by 5. Huh. And what'll that do? Oh, look at that. At the end of 2013, we had 5 too much retained earnings, didn't we? But then if you have 5 less income than you should have in 2014, what does that do, guys? What's 5 less 5? Nothing. What's wrong with equity? Nothing. What's wrong with liabilities? We never touched liabilities. What's wrong with assets? It's got to be nothing, but isn't that right? We said there was no error at the end. So what would have happened here? I would have had 3,000 too little net income in the first year, 2012, 8,000 too much in 2013, and then 5,000 too little in 2014. Those are what my errors would have been each year. Add those up. What's -3, +8, and -3, I'll add, -5, I'll add it together. 0. So the total is just fine across the years. What if I told you they made 100,000 in each year? They reported 100,000 in each year. What's their real income? I guess 97 the first year, 108 the second year, and 95 the third year, huh? Did I do that right? No, it was 3,000 too low, it'd be 103. They should have 3 to it. This would be 8 too high, it'd be 92. This would be 5 too low, it'd be 105. But the 3 years added up, it's still 300,000. Okay? Those will drive you nuts. There's some of those in the book too, aren't there? Just to make life good. Okay? So practice those. You want to do number 4? Yeah, this is really easy if you know what you're doing.
How do you solve?
If you're doing some puzzle. What's that?
How do you solve it? Which is the balance sheet. Are we adding to our assets? Are we adding to offset the assets?
We're not adding. It's just over and understated. How much would we be off? It's how much the error is that we have at a particular time. If you wanted to fix it, you could make a journal entry. If ending inventory is too high by 3, right, or it's understated by 3, you debit inventory, increasing it in credit, whatever else is wrong. Accounts payable maybe, cash maybe, cost of goods sold maybe, depending on how they're accounting for it. So it'd be harder if I asked you to fix these errors. We just want to know what the impact of the error was on net income, right? Okay, it says what's the amount of overstatement, understatement, or effect for each of those. Okay, that makes sense? Richard? Just like we were doing on the earlier chapters. The overstatement, understatement. It's just it's much harder to get there because you have the beginning and the ending inventories both. Okay? So how about on number 4? What would you do? What do you need to know for this? I want to know the net income. Does everybody know that revenues less expenses is net income? Yeah. Except some of these things don't go on the income statement, right? Does cost of goods sold go on the income statement? Yeah, it's an expense. Selling and general administrative expense? Yeah, it's an expense. Miscellaneous expense? Yeah, it's an expense. I've got income tax expense. I had sales. Net of tax loss from discontinued operations. Does that go on the income statement? Yeah, down at the bottom. Discontinued operations and extraordinary items. What about the effect of a change in accounting for income taxes or accounting principle, net of tax? Nah, where does that go? In the retained earnings statement. That's all you had to know to do this. That's why it's only 1 point. What do you do? What's sales? 1 million? Give me the total expenses before tax. Total expenses other than tax, because we have to compute the tax. What's that? 600 for cost of goods sold, 200 for selling general administrative, is 800, 30 for miscellaneous. I think that's it. They're all right together to you. 830? Wow. This is a quick one. What's the net income before tax? Net income before tax is how much? 170? What's the tax rate for tax expense? 40% I gave you? I just calculated it. Revenues less expenses, right? Other than tax, and we have to calculate what the tax is. Okay, I don't want the loss from discontinued operations yet, because it's going to be net of tax. They already did it, took the tax out. If they didn't take the tax out, we could take it out. That was a $100,000 loss, less 40,000 taxes is 60,000. That's all it is, 40%. I could have said it was before tax of 100, and you could take 40% away from it. Be all right. What's tax expense? What's 40% of 17? 28, 56 is it? 68,000. Oh, what math skills? 34 doubled. Come on, Keith. 68,000. All right. Subtract that expense. Everybody good? So what's my net income before discontinued operation? Oh, how much is that? 102? And then the discontinued operation is already net of tax. They already took the tax out. How much is that? 60,000 was it? And it's a loss, is it? Okay. discontinued operations loss. So how much net income do they have? 42,000. That's it. Just let yourself relax and think about it, huh? Okay. What if they had an extraordinary item instead of a discontinued operation? The extraordinary item also goes after taxes here, right? Okay, so it'd go down in here too with the discontinued operation. That's all you got to remember. What if they had a prior period adjustment? That goes to retained earnings too. Change in accounting principles and prior period adjustments go to retained earnings. So that was easy to see if you read carefully in chapter 5, really. Okay. Number 5, how about that one? We didn't do this in class, but they're just so simple. What's the deal with these discounts? What's a discount? There are trade discounts, and then there are sales discounts, or purchase discounts. What's a discount for? Trade discount is just price reduction. So you might have a list price. You ever seen list prices on things? You know, it'll say the list price is $1,000. Actually, for businesses, the list price might be $1,000 if you're going to sell it to consumers for it, right? And they might sell it for $600 or $500 or $400. I'm not kidding, right? Okay. So let's say that you were going to sell it for $600, and it's got a $1,000 price tag. What's your trade discount? 40%, $400. Yeah, it should be 40%. It's real common. All it is a price reduction. So when you hear about a trade discount, it just means they have a list price, right? And then different customers get different prices. That's all. And you only get different prices for if you're big and you're buying a whole lot, or you know they have to ship it a long ways, or it's expensive to install, or something. There has to be a reason for it. It can't just be I like you and I don't like her, so I give him a 40% discount, I give you a 10, and you're competing with each other. You'll go bankrupt, right? You don't make a lot of money. And no. So you're exactly the same type of customer. But if he buys 100 times what you do, then you give him a better price. Okay? That makes sense? It's fair. Okay. So, all right. And big companies still get an advantage, don't they? Because they can buy a lot. Okay. But then they have to inventory it. They have to keep it. All right. Anyway, and then what's the cash discount for? It says 1% 10 net 30. 110 net 30. That means 1% if you pay within 10 days. Net if you pay within 30. That's all it is. So how long are you borrowing money for? You have to pay in 10 days if you get the 1% discount. You can wait 30 days if you don't get the 1% discount. So how many days do you get to wait? Well, you get to wait 30, but how many additional days? Well, it had to be paid in 10, but you can wait till 30. So how many additional days? 20, right? You get to wait 20 more days. Isn't that right, you guys? You know, I can pay the 10th. If I bought the first day of the month, I can pay the 10th, or I can pay the 30th. 20 more days, right? You could have 1% 15 days, net 30. You could have 2% 10, net 30. There's all kinds of different discounts, okay? And these are basically industry specific. This is very, very expensive. 1%, how much interest are you earning if it's 1% for 20 days? How many 20-day periods in a year? How many days in a year? 365, right? Divided by 20. How many 20-day periods in 365? 18, and you're getting 18 a little more, right? Yeah. And how much discount are you getting? 1%, 18 times. It's 18% interest, isn't it? It's actually more. Okay? 18% interest. What if it's a 2% 10 net 30? It'd be double 1%, you guys. It'd be 36, almost 37% interest. Wow. Who would give anybody that kind of interest? Can you earn that kind of interest if you went to the bank and put your money in a savings account? You can't make that kind of interest on anything. The stock market only earns 12 to 13% a year. Why would you give somebody this sort of discount? One, because it's your industry practice. You're kind of stuck with it, right? Your competitors are doing it. But here's the big one. If you pay me within 10 days, you are more, if I have terms where you have to pay me within 10 days, you're more likely to pay me than if I give you 30 days. It reduces bad debt exposure. If I require cash from you, I have less bad debts than if I give you credit. If I only give you 10 days to pay instead of 30 days, I have less bad debts. Does that make sense? That's it. Okay? So that's where this came from. Used to be lots of people would have 2% discounts. Now they're 1%. They've gotten those down, and they extended the days out a little bit. Okay? But anyway, different companies. But you can do whatever you want. So how would you record this? This is just what we've been doing all along, you guys, only now we added discount. It says they sold 5,000 of goods to Southern Company on credit. At the time of the sale, they debited accounts receivable and credited sales revenue for the 5,000. I bet you could have done that anyway, right? Should have let you do it, whoever did this quiz. Debit accounts receivable, 5,000. Credit sales, 5,000. That's already been done. Told you they did that. Yeah, sure. That's what you do at credit sale, of course. Okay. And then terms are 1%, 10 net, 30. Okay, so this is May 1st. That's May 1st. Okay, present the entries they would record in each of the following situations. Southern paid the balance due on May 10th. Okay, so they pay the whole thing on May 10th. They paid it within the terms, didn't they? So do they get to take the discount? Yes. So how much cash are they going to give you? Yeah, they're going to get 1% of the 5,000 as a discount. That's $50. They're going to give you $4,950. Right? How much account receivable are they satisfying by giving you $4,950? All 5,000. Excellent. So this is pretty easy, isn't it? If you did a couple of homework problems, this is kind of a snap of the examples. What's the 50 going to be called? Sales discounts. That's it. What kind of account is sales discounts? No, that's a good guess. It's a debit balance, so it looked like it'd be an expense. It's a contra revenue. Okay. So what I'm going to do is I'm going to show on my income statement sales less sales discounts, and if I have them, less sales returns and allowances. Those are both contra accounts, so they'd have debit balances. That makes sense? And the difference is going to be my net sales. That's it. Just not a big issue in here. Purchase discounts work the same way. It'd be purchases less your purchase discounts less your purchase returns and allowances. That's it. Okay? So that's what you'd do if it was May 10th. But what if, let's do part C. What if they paid their bill on May 30th in part C? So this is part A. This is part C. What if they waited until May 30th to pay it? Anytime they want to pay after 10 days, what do they have to pay? Full price. You got it. So how much cash would they give you? 5,000. And how much account receivable would they satisfy? 5,000. Nothing to this, is there? Okay? All right. Let's try part B. Now in part B, they say on May 4th, they returned half the goods. What would you do then on May 4th? You wouldn't have to write this entry down, but it would be helpful if you did. What would you do on May 4th, guys? Yeah, debit, sales, returns, and allowances. You got it. Did some problems, didn't you? How much? Is it half of it? 2,500. And credit what? Accounts receivable, because they now owe us 2,500 less. So the way to think about this is you had 5,000 in accounts receivable. Now you credit it for 2,500. What's left in 2,500? So now when they pay you, what are they going to be paying off? You said they did it on May 10th. So they're still going to get a discount on May 10th, aren't they? Yes, only 1% of what they owe you, right? They bought 5,000 from you, would you give them a $50 discount? But you're not going to give them a discount when things are returned, are you? So it's only going to be on the 2,500 they ended up buying from you. That makes sense? Okay. So that's only going to be a $25 discount, isn't it? You got it. Debit cash, $2,475. Control if I give you one of these problems. Credit accounts receivable, how much? 2,500, and guess what the 25 is? Sales discounts. Got it, guys. You're good. This is all called the gross method of recording sales discounts. There's also a net method that we'll worry about in intermediate, okay? Where you take the discount out up front instead of waiting until they pay you. So what would it look like if they did this, you guys? If they took that approach. What would I have for my sales? 5,000. What would I have for my sales discounts? $25, right? And what would I have for my sales returns and allowances? 2,500, huh? And what would my net sales be then? 5,000 less 25 less 2,500. What do you get? 475. It's a miracle. It's the cash I got. Ta-da. Okay? So that's fine. Why would you want to show this? The discounts cost me money. Sales returns cost me a lot of money. To send product to people and pay the freight to get it to them, it's the wrong stuff, and they return it, and I have to pay the freight for it to come back. And I have to package it all up and do all the warehouse and getting it out, and then I have to unpack it and put it back in the warehouse when it comes back, and it might be damaged in the process. It's a disaster. You would never want to see your sales returns and allowances half of your sales, would you? You need that to be a little tiny number. By the way, you guys know who Nordstrom's is, right? Anybody shop at Nordstrom's? You can't in Louisville. Yeah, you can. Online, UPS delivers. My wife shops not every day at Nordstrom's, but lots at Nordstrom's. Boxes show up all the time. They have a really liberal return policy because they don't want to build a whole bunch of stores. They were one of the first ones doing it. They have some really nice stores. They're probably one of the nicest. What do they call those stores? Department stores? Yeah. So, what are they called in this town? There's a Bon Mar or something. Places like that. Is there a Nordstrom's off the Rocky Town? That's their seconds and stuff. But if you go to Chicago, it's an incredible Nordstrom's store. There's one in Indianapolis. They're all over the country. They started out on the West Coast. But they're in all the major cities. That's why they're not in Louisville, I guess. But anyway, Atlanta has them. But they have a real liberal return policy, so they don't have to have lots of stores. Don't have to have as many stores. So when you buy something from them, if you don't like it, they pay the freight to get it to you and the freight to get it back to them. Think what their sales returns and allowances would look like. Big, right? How can they afford to do that? Their gross profit percentage must be huge, right? They sell things they streamline their profit, right? They charge more for their goods, right? So, and then they sell real high quality stuff, so it definitely returns much too, for that reason. Okay, good. Those are easy, huh? So can you do a bank reconciliation, you guys? Was this easy? Can you work through it? You cheat, have the book open. What is a bank reconciliation? You want to do this one?
Yes.
Okay. What does a bank reconciliation do? Or we could do one in the book or something. What do we want to do? I want to find out what the balance is supposed to be in cash on my general ledger, right? What's the real balance in cash? What do I know when I start this process? I know what the balance is. Oh, by the way, you can set this up any way you want. This isn't a financial statement. It's just for you to find out what the balance is, right? Balance per books. Okay? Start with that. On the other side, we'll start with balance per bank. Sound good? And then what we're going to do is we are going to adjust each of these, right? Figure out what the real balance is, okay? And we're going to call that an adjusted balance. And we're going to keep working, I guess. We're going to keep working until I get the same adjusted balance here and here. Got to be the same number. And then I know I'm done. That's all there is to this, you guys. So I want those two numbers to be the same, here and here. Got it? Where would you find the balance per books? In your general ledger, right? It's the account balance. Where would you find the balance per bank? It's the ending balance in the bank statement. That's it, okay? So if you have your own checking account, you should be doing this all the time, every month, okay? It's not a big deal. So what's the ending balance on the bank statement? I can see the balance from the last statement. I see the total deposits and credits. Inside the box there is the bank statement, huh? And then it shows the total checks and debits and the balance on this statement, which agrees with the balance down at the bottom on this statement. We know what it is, don't we? How much? Balance per bank. That's it. Yeah. Now, I don't know how much cash they should have yet. I'm going to work on it until I figure it out, okay? But that's my starting point. Sound good? Okay. Good. What's the balance per books? It says the cash balance was at November 30th was 10,740.93, and then they wrote a bunch of checks in December, and they had a bunch of cash receipts in December. But then I didn't give you the balance in the cash account, did I? So what are you going to probably have to do? It's kind of annoying. What are you going to have to do with this one?
Just add them over and subtract.
Yeah, figure it out. Let's do per books. It's a cash account. The balance at November 30th is 10,740.93. Okay? What do you need to do? I think add all your deposits. I told you that November 30th, 2012 is 10,740.93. Okay? So here's all the deposits, cash receipts. Here's all the withdrawals, checks. Add them up. What do the deposits add up to? Add those receipts up. 843.86, 941.54, 808.58, and 967. I'd draw a line there if I were you guys and write it right on there. Did anybody do it? You've tried this problem yet? No? You guys doing it with your calculator now? Somebody, a couple of you do it so we get the right answer, so we can compare answers. 843.86, right? That's a receipt. 941.54, 808.58, 967. That's what they thought they received. Those are going to be all debits to cash, aren't they? So take the total of it. 3,000 something. 3. This is too easy, isn't it? Okay? And then it's a pain, but it's easy. The withdrawals are all the checks, right? Add up all the checks. Twice as many checks. Add those up. And of course, that would come out of cash. $10,000, $4,000, $5,000. Good job, Keith. I'm going to say that's too much. 90. 5,565.90. So we had 10,740.93. We would add the deposit of 3,560.98, and then we would subtract the withdrawal of 5,565.90. And what do you end up with? 8,000 something? That'd be the 12/31 balance, wouldn't it? Yeah, your debits added together. Beginning balance debit. Deposits are debits, right? Cash receipts. Cash disbursements, the withdrawals are credits, right? Looks like 8,000 something to me.
8,736.
Everybody good? You could do that, couldn't you? So that's the balance per books. So it made the problem kind of hard, just because it's annoying. I had to figure that out. Okay, what I want to do is get this number to an adjusted balance here, and get this one to the same adjusted balance. Okay, so what kind of things could there be? What kind of things could I know about that the bank doesn't know about? Yeah, what do we call those? Outstanding checks. That's it. Outstanding checks. What'd you call them? In transit? That's the deposits. So that's fine, that's the other one. Okay, so outstanding checks we call them. Okay, no big deal. That's what it's called. Okay, I know about them. I took them out of my bank account, didn't I? All the checks that I wrote are total $5,565.90. There they are, right? We know what they are, okay? I recorded all those in my books. Does the bank know about them yet? Well, not all of them. Some they know about, some they don't. So I'm going to subtract any outstanding checks they don't know about. You like that? That makes sense, huh? And then the other one is deposits in transit. That's good. What's that? I sent the money to the bank, right? I received checks from the customers. I stamp on the back of the check for deposit only, right? So it won't go into anybody's account but mine. For deposit only to my account. I put them in an envelope, a deposit slip, and I mail them to the bank, right? Or maybe we carry them to the bank, but the last days would be delivered to the bank after the close of business at the bank, right? Because they quit posting any activity after 3 o'clock at banks, and your business stays open later than that, of course, right? Okay, got the idea? So they don't know about it. So it's deposits in transit. And all we do is we add the deposits in transit and we subtract the outstanding checks. That makes sense? There could be a bunch of that kind of stuff. Okay, what kind of things could the bank know about that we don't know about? A whole bunch of things, really. But real common ones are they charge us fees, right? So there might be bank service charge, which would be a bank expense of some kind. That would be subtracted. But there are sometimes other things too. Sometimes we'll receive a deposit, a check from a customer, and it'll bounce. We call it non-sufficient funds, right? They didn't have money in their account, but when they gave us a check, they didn't have enough money to cover it, right? So they gave us a bad check. We deposit it to the bank adds it to our balance. They think it was a good check. Then it runs through the banking system, and guess what happens? It's not good. They took the money back out of your account, plus a bunch of fees, by the way. And then you have to go try to collect it from your customer. So it'd be an account receivable again, maybe going to become a bad debt, right? If you never find it. Everybody got the idea? So we could have NSF checks. I don't know if we got them here or not yet, okay? Although you can look at it real easy. I see one, don't you? Look at the bank statement. See that NSF sitting there? Non-sufficient funds. So I guess we do have an NSF check. Would that increase or decrease my balance? If I put in a deposit but it wasn't real? Yeah, decrease it, take it out. Okay? And then there could be other things. I see a service charge there too, don't you? What is that CM over there? Credit memo. The bank collected some money for us, right? And by the way, they call it a credit memo because they're crediting our account. When they credit our account, they're increasing the amount they owe us. Our cash in their bank is a liability for them. They owe us the money. We would debit cash, increasing it. They would credit the liability to us, right? They're doing their accounting, not ours. So that seems backwards, doesn't it? These debit credit memos are strange, right? Debit reduces your account, right? Credit increases. They owe you more. Credit, they owe you less. Debit. Okay, anyway, they're doing their accounting, not yours. So there is a credit memo, and down there it says that was on collection of a note, huh, with some interest. So note collected. So you guys, does anybody in here have their account set up so you automatically pay payments for rent or for anything like that? Insurance? Yes. 2 yeses maybe. And my wife doesn't like to do that. I don't know why. She likes to do it herself. Okay, she's afraid they'll keep doing it after. And I guess we have had that happen. But anyway, they'll automatically withdraw for you if you want. Okay? They'll automatically make payments for you. They'll also collect notes receivable for you. Just get it set up, and the people who owe you the money send it to the bank, and they put it in your account. They charge you fees for this stuff. Okay? Like anything else. All right. So a note collected would get added in there, wouldn't it? Deposit and transfer would get added. So those kinds of things could be out there. How do you find them? Well, kind of look for them. It's kind of annoying. Let's start with deposit and transfer. Do you see the deposits that got to the bank? Are there deposits that got to the bank? there's a column for deposits, isn't there? This thing's kind of hard to read. But there's a column for deposits, isn't it? The first one is 5,484.38. Was that recorded on our books too? How about that one, December 1st? That was a deposit, and then there's the 843, and then there's the 941, and then there's the 808, right? Then they put in the 1,100. Well, what was that deposit then? $967 never got there, huh? I think the 967 is a deposit in transit.
What about that?
Yeah, what about that first one? 967 even is a deposit in transit. Everybody see why it is? We received it, put it on our books at December 31st, and it never got to the bank, did it? So it's not there yet. That makes sense, December 31st, last one. What do you think the first one is on December 1st? It's a really big amount that kind of throws you off, doesn't it? What was that probably? It was a deposit in transit last month, at the end of November. Ah. And hadn't gotten there yet. Okay? The balance was kind of low at the end of the last month too, 5,400. That deposit hadn't gotten there yet. That's all that is. Okay? So you can ignore that one. How about the 1,100 credit memo though? What's that? The bank put it in our account, but we didn't know about it. So where would we put that? Note collected, right? Okay? And down below it says that includes interest of $60. So of that 1,160 is interest, and the rest, 1,040, I guess, is payment on a note receivable, huh? Okay, good. Well, let's try the outstanding checks then. How about those? Which ones cleared the bank? It looks like some old ones cleared that probably were outstanding before. That makes sense? Number 14, we didn't write that this period, did we? Okay. Did number 17, so that would have been outstanding last time. Did number 17 clear the bank? Yeah, it's in both lists, isn't it? 372.96. How about number 18? You see number 18 there? Yeah, except the one on the bank statement says 708.62 and ours says 780.62. What's that? It's a mistake, right? That's an error. So we can have errors too. Who's more likely to make an error, the bank or us? Us. Why? All the bank handles is cash. Cash in, cash out. That's all they do. We do a whole bunch of other things, right? Running our business. So before you call up the bank and yell at them, you know, that they screwed up your account, call them up and say, I can't figure it out, because they'll probably show you where you're wrong instead of them. They do make mistakes, though. It happens. But what happened here? Down below they say what? Yeah, we recorded at 780.62. So what's the difference between those two? 72 bucks? And we're probably wrong. So which direction does it go? The bank has it recorded right. We took too much out. So what should we do? To our cash account. If we took out 780 and it should have been 708, we need to add back the 72, don't we? Okay? That makes sense? Yeah. We should have only taken out 708. So we need to increase our account by 72, was it? That's true, isn't it? You took out 780, you should have only taken out 708. That's all it is. So each one of them, just look at it and think about what it is. Right? Kind of a pain. Okay? All right. So we did that one. Take a look at 19. It's 157 there in both places, right? How about 20? 20 didn't clear, did it? You see it? 587.50. So I think outstanding checks are going to include number 20. 587.50. Okay? Everybody agree? It didn't get to the bank. How about number 21? Yeah, that's there, 234.15. How about 22? Yeah, it's in the third column. I don't know why they're not in order. Nowadays, by the way, they're in order. I don't know what's wrong with this. The banks always put them in order for you. And then they put a little asterisk next to it every time they skip a number, which is kind of nice. You can tell where they're missing. 578.84. And then 23, did it make it? No, that one didn't. So 23 is outstanding. Okay. 168,750. All right. So that one's outstanding. And then number 24, did it make it? Yeah, 921.30. And then number 25, 246.03. And in real life, there'd be thousands of checks. Well, what happens is the last day of the year, you mail a whole bunch of checks. How many of them clear the bank? None of them. They're in the mail. So you'd have a whole block of them that are outstanding, maybe for a couple of days. And then you'd have to scan back and find the other ones. And we have computer programs to do it for us. Okay, so that helps a lot. So anyway, there we go. I think that's all of them, isn't it? So what's my total outstanding checks? Add those two together. By the way, when you get done with this, you know whether you did it right or not because your adjusted balance will either balance or it won't, right? If it does, you're in good shape. What's 587.50 plus 1,687.50?
2,275.
All right, we'll take that out. That's kind of explaining the difference between these two, isn't it? That's the big one. Okay. All right, what do we have left that we haven't done anything with? The NSF check, right? It's 250 coming out. Okay. The bank put it in our account. We put it in our account. They took it back out. We haven't taken it out yet. Okay? We need to take it out. How about the $15 service charge? The bank took it out. They charged it to us. We don't know about it yet, so we need to record it. That's all.
Let's say 1126 or 1.00.
00. 9 zeros a week. Huh? Okay. Yeah, 1100 even. Okay, so now let's try it. Add 8,736.01 plus 1100 even, less 15, less 250, plus 72. What do you get? See how low we did here. $9,000 something? Or is it still 8,000?
You added, I'm not that wrong, sorry.
8736.01 plus 1100 even, less 15, less 250, plus 72.
Got 9,643.01.
9643.01. Okay, let's try the other one. What's 10,955.01 plus 967? I like the 01. Less 2,275 even. What do you get?
I got the same thing, yeah.
It's a miracle. Okay, so that's it. We're right, aren't we? That's the bank reconciliation. What about the journal entry? You wanted these two numbers to be the same. That's what we're doing.
So when you say prepare a bank reconciliation, are you going to want to write it written like we did up here?
Yeah, like this. Or if you want, you can start with the balance per bank and work down to the balance per books. But it's really, I think it's better to do it this way, side by side. Get down to the adjusted balance. You can see it better. We have one other thing to do, though. So, I'd like you to do something that looks like that. And you can make it real cryptic, right? Okay, just abbreviate like it is there. It's not to publish to give to anybody anyway. Okay, it's for yourself. Prepare the adjusting entry. Whose books do we keep, the bank's or ours? Yeah. So we're going to make an adjusting journal entry to adjust from the balance in the bank account here to the correct balance. What do you think about that? The balance in the account right now is 8,736.01. Everybody agree? That's what's there. We'd like it to be 9,643.01. Don't call up the bank and tell them they're wrong because there's a deposit in transit. Don't call up the bank and tell them they're wrong because there are outstanding checks. They're going to find out about them when they get there, right? Okay? So, I'll do another cash account here just so we have room. Right now, it's 8,736.01, and I would like it to be how much?
9,463.01.
Okay, what's the difference between those two? I bet that's my debit to cash. 970, is that what that is? 907, okay. I'm going to debit cash for 907. How about you guys? Don't make a whole bunch of entries for this. I know the authors do, but what a waste of time. Just write one, huh? If I want cash to be bigger, what do I do to it? Yeah, if I want it to be smaller, what do I do to it? Credit, yeah, big deal. Okay, what else do I need to do? Well, record each of these. Okay, the note collected did what? It was a note what? If they paid me, what was it? Receivable, excellent, and it's going down, so debit or credit? Credit. What did they say the note receivable was for? It's not 1,100 because the 1,100 included what? $60 of interest, right? That has not been accrued. Okay, we haven't recorded the income yet, right? So how much was the note receivable? 1,040, was it? Yeah. What's the $60 going to be? Interest that has not been accrued would be interest what? Nah, they owe us money. Expense would be a debit. What's this? It's a credit, note receivable. So this is interest what? I loan people money and they're paying me interest. It is interest revenue. It'd be interest receivable if you had accrued it. The reason they said they had not accrued it is they wanted you to go to revenue. If they said it had been accrued, what would you have done earlier? Debit interest receivable, credit interest revenue, and then that would have been a credit interest receivable here. Okay? So that took care of the first one. How about the bank service charge? What do you want that to be? Maybe miscellaneous expense or bank service fee expense. Call it some kind of an expense. $15, huh? Right? Debit expense. The NSF check, it's from a customer. What would we do? Put it back into what, you guys? Accounts receivable. Excellent. 250. They owe me now, right? Okay. Maybe later I'll write it off, but for now I probably put it into receivables. And what about the $72, the last thing we got? That's debit cash. It's part of the debit to cash, and it's credit here, $72. What did they say it was? That was a payment, right? The entry has not been made for the NSF check. Error. And we were writing a check, probably went against what?
When we wrote the check, we took out.
We took out too much. So we credited cash too much and we debited something too much. What do you suppose we debited too much? Accounts payable. When you wrote your check, what would it be? Credit cash, debit accounts payable. So let's put it back into accounts payable because we reduced accounts payable too much. That's it. Journal entry balance. That's the second half of it. So there are a bunch of those problems too in the book, huh? Right? Probably tried one or two of them. This was harder than most of them. You can work this one, you can probably do most of them. Nah. 5 points. I give you 50 minutes for 25 points or 30 points, right? 50 minutes for 30 points. 8, 9 minutes to do this? 10 maybe? Sure, you do it. Total confidence in you guys. Practice, practice, practice. You got a few more minutes? Maybe we do. What problem did you say you wanted to do?
It was like 75 or 76.
Problem 75? Excellent. We're calculating inventory and cost of goods sold. Good. A little more practice. It's a good one. On page 362, exercise 7.5. Calculating ending inventory and cost of goods sold under FIFO, LIFO, and average cost. The key thing to look at here is, are they periodic or perpetual? What are these guys? Periodic. See it? Penn Company uses a periodic inventory system. I'm doing 7.5, was it? 7.5. They're periodic. What does that mean, you guys? They pretend they buy everything before they sell anything, right? So it's real simple, relatively simple to do periodic. Okay? Perpetual is the one where we have to do that key account to keep track of everything in and out. Okay, so then they say the end of the accounting period, December 31st, 2015, the accounting records provided the following information for product 1. Okay, here's how much they started with, and it cost them $5, and then they have 2 purchases. Then they have their ending inventory. Okay, so just let's think about what they would keep and what they would sell. So FIFO, and these are all periodic. So here we go. We don't care when we sold it, but we can figure out what we sold. So I think what I'd do is just, I kind of like this approach. Units, beginning inventory is how many? 2,000. Okay. Purchases, purchase 1 is 5,000. Purchase 2 is 3,000. You don't have to do this, but you can see it when you do. How many do we have available, you guys? 10,000. How many are left at the end? How many do we sell? 6,000. That's it. We know where we're at. This is what cost of goods sold is going to be. This is for units, right? And this is what ending inventory is going to be. Does everybody agree with that? Okay. Then we're just going to convert it to dollars. Okay. So, what do we have? They want ending inventory and cost of goods sold. Okay, so here we go. Let's do cost of goods sold schedule for this. Beginning inventory is how much? 2,000. It cost me how much? Maybe we'll do dollars too. Might be handy. Okay, these cost me $5 each. How much was purchase 1 costing me? What was purchase 2 costing me? 5, 6, and 8? Man, their costs went way up, didn't they? Okay, lots of inflation there. Okay, so what we'd start with is beginning inventory of how much? 2,000 times 5, or $10,000? Everybody agree? You can do that. Beginning inventory is $10,000. Let's add our purchases in here. There are 2 of them. So purchase 1, 6 times $5. Everybody agree with that? 30,000, do it? Yeah. And then we had $8 times 3,000 units for purchase 2. How much was that? 24. So my total purchases are 30 and 24, or 54. Does everybody agree with that? My available is how much? 64,000. And what I want to do then is calculate my ending inventory, right? And my cost of goods sold. So you could either do it this way, or you could do it in the schedule up here, one or the other. It doesn't really make any difference. Okay? All right. So, what will I do? FIFO, periodic. I have 4,000 left. Which ones? First in, first out, I kept the last ones. So here are 3,000 at $8. Do I still have those? Yes. 3,000 units at $8. This gets real easy if you work at it a while, guys. 24,000? We already calculated it was 24,000, didn't we? In order to put it down here. And then how many more do you need to make 4,000 units? 1,000 more. Which ones are they? The next most recent purchase, right? First purchase, I'm sorry. So it'd be of these 5,000, so it'd be a $6 one, is that right? So is that 6,000? I think for FIFO, my ending inventory is $30,000 for 4,000 units. Did I do it right? I think that's it. So now, in dollars, I had 10,000 beginning, plus I bought 54, available is 64, and now what happened? My ending is 30, so guess what my cost of goods sold is? 34,000. See it? We could do this, couldn't we? Easy? Pretty easy? We said there's 4,000, they gave us that, right? So which 4,000? It was first in, first out, it had the last ones. So 3,000 at $8, right? And then I go back to the next most recent purchase, so it's 1 at $6, 1,006. Did I do it? I wish they'd give us more purchases. You're going from the most recent backwards. So we took $8 ones, then 6. Okay? That do it? Okay, so that's FIFO. Let's do LIFO. What would it be? Ending inventory. Now let's think about this. On LIFO, oh, this is the ending inventory. And we calculated cost of goods sold to be 34,000. Okay, so we can compare these later. Okay, on LIFO, the ending inventory, we still want 4,000 units, don't we? It's a nice little problem. Okay? It's kind of the same one I gave you, only it looks different. Huh? It's got the same idea. Okay, so which ones are we going to have? Last in, first out, I would sell these $8 ones, wouldn't I? And I'd sell some of these $6 ones, and I'd keep these $5 ones and some of the 6. So I go back to the beginning inventory. That's 2,000 units, right? At how much? They were 5. So that's $10,000, right? Excellent. And then how many more do I need? 2,000. And what'd they cost, guys? $6. Excellent. How much is that? 12,000. And we're good. So how much is the inventory now? 22,000 instead of 30. Everybody got the idea? That's my ending inventory. What's that going to do to my cost of goods sold, of course? Well, if you only have 22 in ending inventory, you're going to have a lot more cost of goods sold, aren't you? Right? 64 less 22 is how much? 42. Ta-da. Getting it, huh? And then they want average. So this is going to be weighted average because it's periodic, right? We can't change this problem into perpetual because they didn't tell us when they sold things, did they? Right? So we couldn't do it. We'd have to make that up. Weighted average would be what? Well, what's the deal? How many units do they have available? 2,000 plus 5,000 plus 3,000. We said 10, huh? Yeah. And what did it cost for all those units? 64,000. So couldn't you just take your $64,000 cost available, right? Remember to include the beginning inventory and the purchases, right? It's everything. And divide it by 10,000 units. That included the beginning inventory too, right? 2 plus 5 plus 3, 10. It's $6.40 each, is that right?
Yeah.
So the ones in ending inventory are how many? How many units, guys, in ending inventory? 4,000. What did they cost? $6.40 each. Multiply that out. 25.6. And notice that inventory number is somewhere between the 30,000 for FIFO and the 22,000 for LIFO, right? It's an average kind of them. Okay? And then cost of goods sold, how much is that going to be? How many units? We sold 6,000, didn't we, guys? Yeah. What did they cost on average? 640. What's 6,000 times 640? Yeah. Okay, let's prove ourselves right. So ending inventory would have been 25.6. What's 25.6 away from 64,000? It's a miracle. 38.4. Keep those keys a few times, pound on them, keep working. What's happening, what's happening, what's happening. Make sure you're understanding as you go. Now just do them. Like you said, if you have your books, the bank reconciliation's easy, and it's your book though, but it's still easy. You just think about it, right? And it's much faster than looking back at the book. Same with this, okay? That's a good one. Got more? You've been trying to do, driving you crazy? The many of these 3 chapters. Is there a perpetual one here? They're kind of obnoxious, aren't they? Don't have you do perpetual. Want me to make up another perpetual one and we'll do it real quick? We got a half hour.
Yeah.
Let's try this. Okay. January 1st. Beginning inventory. 20 units at $4. January 10th. Purchase. Units at $5. January 20th, sale 15 units. And we would only know the sales price, right? So we don't know how much the cost is, okay? So if I wrote down a sales price, ignore it, it doesn't mean anything. On January 25th, purchase 18 units at $6, okay? And January 30th, sale. $20 units. Okay? So there's the world you got. And give me LIFO, perpetual, that represents inventory, right? And give me, this represents inventory too, give me moving average. There we go. Perpetual. If we were using, by the way, FIFO perpetual is exactly the same as FIFO periodic, so you don't need to do that with a T account, do you? If I was going to do FIFO or LIFO or weighted average periodic, it'd be just like the last problem we did, right guys? So this is just letting you have a chance to use perpetual. Do those two. What I want to know is for each, ending inventory and cost of goods sold. Okay? For each of these. And it'll be right there in the T account when you do it. I think I'd find out what my ending inventory was in units. Maybe do a little schedule for cost of goods sold.
It's all right, yeah. Yeah.
You didn't do one,
Oh, yeah, yeah, I did, yeah.
but it's kind of involved with If you want, you can do periodic LIFO average to regular. Okay, gang, got answers? Want to do it? You good to go? Okay, I think what I would have done, maybe, set this thing up, cost of goods sold, beginning inventory, right? Purchases, let's do available. That's my ending inventory. Cost of goods sold. You don't have to do this. Kind of keeps you straight though. Okay, what was the beginning inventory? 20 units. $4 each. What's that? $80? Okay, and then I purchased 10 at 5, right? And then I purchased another 18 at 6. So what's that? 50 and what's 6 times 18? 108. So 158?
Yeah.
There it is. And it was 28 units. So just so we know where we're at. 48 units available that cost me $238, is that right?
Yeah.
Okay, and then what I want to do is I want to figure my ending inventory. Well, I sold 15 and 20 is 35, is that right?
Yeah.
So my ending inventory is how many? Did I do that right? I sold 15 and 20 is 35. I only bought 18 and 10 is 28. And I started with 20. That's right. 48 less 35 is 13, is it? I did it backwards. No wonder you guys are. 13 ending? Okay. So 35 sold. Okay? All right, so all I'm going to do is I'm going to figure out these two numbers, huh? But I'm going to work my way down until I have 13 units left. Okay, so inventory LIFO perpetual, what would we start with? My beginning inventory is what? 20 times $4 is 80. Okay, and then there's a purchase, right? So purchase 1, 10 units at $5 is 50. I have 2 layers. Which layer is going to go first? It's LIFO. The first purchase is going to go first, right? So when I do 15, there's going to be 15 units sold, right? It's going to be 10 at 5. Then 5 units at $4 is going to be $20. So it's debit cost of goods 70, right? And credit inventory 70. Okay? What I have right now left then is what? I get rid of all these. I still have 15 at $4. Right?
Yeah.
I have the original layer left, but only 15 of them because I sold off 5. So that's going to be $60 left. Everybody agree? Okay. Then what happened? Purchase 2. How much? That was 18 units, we said, at $6. What did you guys tell me? That was 108? All right. So now I have $168 in those 2 layers. When I sell them, which ones am I selling first? The second purchase, the most recent ones. Yeah, good. Okay, so I got 20 units to sell. So let's do 20 units. So I'm going to get rid of what? 18 at $6, which is 108. And then I'll have 2 at the $4, which is going to be 8. So cost of goods sold there is 116, debit cost of goods sold, credit inventory. And what do I have left now? 13 at $4. Okay, is, I kind of screwed up the problem because that's exactly what would have been the answer had you, because I always depleted the more recent layers. That would be the same answer as LIFO periodic, right? It would, but it's just a coincidence, right? And the reason is all that I have left are from the beginning inventory, right? You could have other layers too, of course. Okay? If this had been the year end, for instance, I would have had two separate ones, right? Okay. So I get $52 for my ending inventory, and what is my cost of goods sold? $238 less 50, how much is that? $186. And does a 186 make sense? What's 70 plus 116? 186. It's a miracle. Okay, anyway. So then, moving average. Every time we buy something, we're going to have to change the average. 20 units at $4, right, guys? That's $80. Then we buy versus purchase one, happens to be 10 at $5 is $50. And what do we have to do immediately? Get an average, right? I've got 30 units at some cost equals 130, right? What's 130 divided by 30? 430 was it? $4.30 each. Okay, and then I have a sale, do I? 15 units. At how much? 430, of course. That's your average. Everybody good? What's 15 times 430?
I don't know if it matters, it's actually 433.
Well, yeah, it does. We use 433. What's 433 times 15? Is that how you guys did this? Am I doing it wrong? You get the average, right? Moving average. 130 divided by 30. It was 433, was it? Okay, times 15 units, how much is that? 64.95. Debit what? Cost of goods sold. Credit what? Inventory. Absolutely. So what do I have left? 15 units, right? You guys agree? At 433, which is going to be the $130 less the $64.95, really 65. So it's about $65. Got the idea? There was a little rounding in there. If I got rid of half of it, it'd be $65, right? Okay. Then what? We purchase another one. 18 times $6. We said that was 108, did we? So 65 plus 108 is the total amount of inventory we have. What's that? 173. Excellent. And then we have 15 plus 18 is 33 units right now, don't we? And we figure out what the average cost is of them. So what's 173 divided by 33? Five something? 524? Okay. 524? That's what that says, honest. Okay, $5.24? Is that right?
Yeah.
Okay, okay. All right, and then what do we have? A sale of 20 of them? Did I do that right? How come I'm going to have too many units left? Oh, 20 away from 33 is 13. Come on, Keith. Okay, 20 units times what? 524 or so? What do you get? What's 20 times 524? You just have it on your papers, don't you? How much is it? That'll leave me with 13 units at 104.80. Nah, 15 at 430 is 60. I guess so. 20. It's 5 more units, isn't it? It's higher price. 104.80. Okay, good. So we believe it. Okay, so what do we have left? 113 units at 524, because we haven't bought any more. We just sold some. Should be the difference between 173 and 104.80. How much is that? 68.20. Is that what that is? Yeah, it's rounding. But yeah, We did it, didn't we? We're brilliant. What's my cost of goods sold, you guys? Those two added up, isn't it? How much is that? 65 plus 105, $169, $170 about. Okay, this is about 170 for cost of goods sold, rounding, right? And this is about $68 here. Okay, would that make sense? Let's check. What do we say the ending inventory is? 68? If 68 is the ending inventory and you take it away from 238, it's a miracle. You get 170. You can do these, can't you, guys? Crank on some, practice them, make up some numbers. Do them. What I gotta do. True?
I know you got $4.36 way at the top. Could you do first?
Maybe it's 433, I think. 130 divided by 30.
Isn't it 10?
We've got 20 at $4 is 80, and we've got 10 at $5 is 50. So we have 30 that costs 130. 130 divided by 30 is 433.
Okay.
It's not 430. He lied to me. It's 433. Little practice, this will be easy, guys. Everything's easy with practice. That's these intermediate too. They actually do it on the test. Following flunking the test. Savings is out. I don't care when you learn it. Learn it. It is, learn it. So where were you guys at 2 o'clock? So we're going to do a review today. I can't make it 2 to 4. Nobody came at all, not one. So I didn't stand here and talk to myself and record it. So there's no recording either. Actually, I don't know if you really need a review of 4 and 5 anyway. I was around, so I thought if somebody wanted to talk about it, I was around. And then I didn't have to do anything, which is even better, right? Be around and not have to do anything. Your test back. Stop this thing.